Hey, good morning, everybody, and welcome to this Tuesday, April 23rd, 2024 edition of Trading Places Live. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for another opening bell. Let's go ahead and get into the market because there's a lot to go over today, and we got the opening bell here in about 25 minutes, so let's take a look. Dow Jones Industrial Average up 253 points yesterday. That was up 0.2%. S&P 500 up nearly 0.9%, 43 points, back above 5,000. So we went below 5,000 yesterday for the first time this year, I believe. Oh, never mind. Wrong. That's right. We were down at trying to battle 4,800. Anyway, it's the first time we've moved below 5,000 since back in the middle part of February. And we did reverse off of it. So yesterday was the first sign that perhaps we're starting to see a little bit of recovery, a little rebound, maybe a floor kind of being established, perhaps. A little early to call that, but there are some other encouraging signs, which I'll talk about in just a second. Nasdaq 100 up 173 points yesterday. That was more than 1%. So Nasdaq 100 really looking strong yesterday. But again, this is the index that's been beaten up the most. So it's got the most to regain. Anyhow, we got off to maybe what could be a good start yesterday. S&P 400 mid-cap index also rising. This was up a little more than 0.9%, and it rose on Friday. So this is actually a couple of days in a row now where we've had gains on the mid-cap index. Small cap IWM, same thing. First time in a while now we've had 2 days in a row of up. And we'll see where we go from there. But small caps rose over 1.1% on Monday. Dow Jones Transports, remember 15.2, pretty much, or 15.250, 15.200, that area, really important support on the way back down. It didn't hold. We went through it, went down just below 15,000. And I'll zero in here so you can see this. We went below 15,000 in the last 2 days. We've been rising. And we've kind of gotten back up to that low that we saw all the way back into January, that mid-January low. So we kind of tested that from underneath. And I think this is going to be the first test for the transports. Can we actually make a breakout above this level? A little early to say. What I can say is that by looking at these AD lines, we still got some work to do. We had this AD line on the Dow, you can see going down. We've kind of come up a little bit. S&P really hasn't shown anything. Why? Because we didn't close near the high of the day. We actually closed like in the middle of the session. So as a result, AD line was just basically flat yesterday. NDX, we saw a little hook coming back up in the AD line. We'll see if that continues. Mid caps flat. Small caps came back up just a tad. And what I'm doing is I'm just looking at this last little piece here. So on this rebound, we're seeing a little bit of recovery, but it's not like we're finishing on the highs. So again, the rebound is nice. It's up versus down, which is good, but it's not exactly flying to the upside. And that's kind of my point at this right now. Transport, same thing, kind of finishing in the middle of the day. And as a result, not really getting a whole lot of rebound in our AD line there. Here's the financials. Financials up through both moving averages. We've really strengthened in financials. This is an area that now has become a leader again here in the short term. Still got some work to do with the AD line, though. I'd really like to see that AD line start to shoot up a little faster. Staples actually seeing the AD line move up. And on a relative basis, Staples have been crushing discretionary. And you might say, well, that's not good. Well, most of it has been in a downtrend. The market's mostly been going lower. So you expect Staples to outperform discretionary in a downtrend. It's when the market recovers. Like if we go back up on the S&P 500 near, or, to or near, or maybe even set another all-time high, and we continue to see Staples outperforming discretionary, that would be a little bit more alarming. So got to understand the situation in the market. But with this recent downtrend that we've been experiencing, it's not unusual to see money get more defensive. That's normally what would happen. And you see it also with utilities. Look at utilities last 4 days, going back to the high that we saw earlier this month, all the way back up to $66. AD line on utilities breaking out. So clearly that the accumulation and the move back to the upside is pretty clear on some of these defensive areas. Moving on to industry groups, airlines, nice day yesterday, continuing a big move up really ever since UAL reported strong results last week. Airlines really have taken off, no pun intended. And beginning of April high has been cleared. So airlines looking really good, along with what we just saw with utilities. Semiconductors finally bounced. This is a group that's really been hurting our major indices. And of course, the flip side was this was a group that was carrying the indices to the upside late in 2023 and then into 2024. That's been a different story of late. And we've continued to see that money rotate away from semiconductors. Yesterday, we got a little bit of a bounce. Some of it came at the open, though. Wasn't like this gap down to trigger new sellers, and then all of a sudden a lot of volume comes in and we come, right back to print some kind of a reversing candle. So I'm just so right now on the semiconductors. I think we got a little bit more work to do to feel more comfortable there. Banks, though, very strong. I've maintained my position. I think 2024 is going to be a good year for banks. But in order to get those smaller banks, small banks, mid-sized banks, in order to get them going, we're going to have to see the Fed really pivot hard toward cutting rates. And what we've been seeing of late has been the opposite. And as a result, many of those smaller banks have not been keeping up. Although I think they did pretty well yesterday. Maybe we'll try and take a look at that chart a little bit later if I have some time. But anyway, that was kind of a quick overview of what we saw yesterday. Some good news, some not so great. 10-year Treasury yield. We did have, let me see if I can pull it up. Well, we haven't had yet, but in about 48 minutes, we'll have the new home sales out for March. That will be out later this morning. And I believe there was maybe one other report. No, not really. Tomorrow we got durable goods orders, and Thursday will be a big day. We have the GDP coming out on Thursday, so that'll give us. It's in the rearview mirror, but the first reading is usually one that the market will react to, and so we'll see where we come in. Last quarter 4, I believe that the latest revision was at 3.4%, and I believe the consensus estimate for first quarter GDP is 2.9%. So still we have strong GDP, economy remaining resilient, but we are seeing it slow somewhat. And we've seen some economic reports. Last week, it was housing starts, building permits that came in way below expectations. I mean, way below. It was, I think it was the biggest drop in probably 3, 4, 5 years in the home housing starts and building permits. So anyway, got some news that are suggesting that, hey, maybe there's some cracks in the foundation of this resilient economy. Not to say that things are rolling over or horrible by any stretch of the imagination, but if we come in lower than 2.9%, I don't know, 2.8, 2.7 would necessarily hurt. But if we see a number, with a 1 handle or maybe a low 2 handle, that could be something that might trigger some fears of maybe the economy slowing and a possible recession at a time when we don't really have inflation quite under control the way we like it. That wouldn't be a good scenario. So watch out for the Thursday report. Just make sure that GDP is somewhere up near estimates. And then on Friday, we've got the personal income and outlays, which is I call personal income and personal spending. But in that report, we'll have the PCE price index month over month, and the Fed likes to look at that. And there's also a PCE indicator in the GDP report on Thursday as well. That's an annual or quarterly. Sorry. Let's see what's expected there. Well, now I'm showing the consensus Q1. I'm pretty sure I saw 2.9% before. I'm showing 2.3% as the consensus, with the range anywhere from 1.7 to 2.8. That's pretty wide range. We'll see how that comes in. But again, GDP on Thursday. And then the PCE annual rate, it is the annual rate. 2.8% is the consensus estimate. The prior was 3.3. So it's heading in the right direction, but we'll want to make sure that there's no big surprise in that as well. So that's something to keep in mind for later this week. Again, that'll be on Thursday. As far as futures, we didn't talk about futures this morning. They were mixed, mostly higher. I think the small caps were down just a bit. Diamonds, let me give you that. Diamonds right now up 0.3%. The Spider up almost 0.4%. QQQ up almost 0.5%. And the IWM basically flat, down less than 0.1%. So still a little bifurcation there in that the small caps are down. But I've got an interesting chart I'm going to show you on the small caps in just a bit. I've made that the chart of the day for today. So we'll look at that in just a few minutes. Anyway, 10-year Treasury yield right now, again, quick update, 4.64%. So we are at a key area of resistance. We talked about the cup and handle and the breakout measuring to 4.66%. That's just an initial target. Doesn't mean that that's as high as the 10-year Treasury yield is going to go. Just means that that's what we should look for once that pattern executes, which it did back at the beginning of April. And when we look at what's happened in the stock market, almost all the selling we've seen has been in April, and it's occurred since we made that breakout on that cup and handle. So it's clear to me that what the market is mostly focusing on is, number one, inflation, and the fact that the Fed's talking more and more about, well, we're not seeing what we need. And as a result, we've had a lot of bond investors selling, and you sell because, well, when you sell, the yields go up. It's the inverse. So when prices go down, yields go up. And so I think what's happening is investors are saying, hey, we need more than a 4.2 or 4.3% return if we're still unsure about inflation. And so I think the 10-year Treasury yield market is repricing based on that news. So we've had yields moving higher to accommodate potentially higher inflation. Whether or not that materializes, again, that remains to be seen. I think overall, until maybe this last week anyway, the consumer discretionary area actually was holding up okay on an intraday basis versus the consumer staples area, but that changed this week. So I'll keep an eye on that to make sure that that's just a short-term thing. But that would be something that you would look for if inflation, in fact, was a problem or was expected to be a problem. You would much rather have consumer staples companies than consumer discretionary, because consumer discretionary, you're relying on more growth, and inflation eats into that growth. So, and higher interest rates brings valuations down. So it's really a double whammy for growth stocks, which is why in April we've been seeing these growth stocks get hit the way they have. I don't think it lasts personally. And I think when you see these yields drop again, which I believe will happen, I don't know when, we'll see. First of all, can we get through 470? That's going to be the first test, because that was gap resistance, the bottom of gap resistance from all the way back in November. Remember, we had an uptrend going into the end of October. And during that uptrend, what was happening to stocks? Stocks were getting hit. We had that summer correction, remember? That was all during rates going up. What happened when rates came down? We had a massive rally. Once we started back to the upside, we did okay in January and February, because many of the value-oriented stocks that hadn't really participated, and I'm not just talking about defensive, I'm talking about, the industrials and financials, which I consider to be part of the aggressive sectors. They were performing extremely well in January and February, and so they helped make up for some of the loss from the rotation out of many of the more aggressive areas like technology and discretionary, and to a lesser degree, communication services. So, we're continuing to be in that cycle, at least short-term cycle of higher rates. And I think that's what's led to our pullback, which I was actually calling for in March, happened 1 month later. So far, I'm fine with it. I thought back in March, we would be back below 5,000. I even thought, I think if you go back to Market Vision beginning of the year, I don't remember what the number was, but I think it was 4750 maybe, or maybe it was lower than that, maybe 40. I don't remember where it was. But I didn't think the market in the first quarter would go over 5,100 either. So everything's kind of been shifted just a little higher. And it's not exactly occurring, wasn't March pullback, it was an April pullback. But still, the overall scheme of things is kind of what I was looking for at the beginning of the year. As we go through the election year cycle, the presidential year cycle, we should expect what we typically see is very, very strong action to the upside over the summer months. So, and May through August is generally when we see growth stocks do their best. I've been telling our members at Earnings Beats multiple times in different reports, shows, whatever, that you need to at least be aware that May through August is extremely bullish for growth stocks. Growth stocks have outperformed value stocks since 2013 by 5.5 percentage points a year. May through August, they've outperformed by 5.3%. So essentially, all of growth's outperformance has come during the next 4 months. Again, that's history. That doesn't mean that's going to happen this year. Maybe this year's exactly the opposite. I'm just giving you tendencies. Like I always say, if you're an NFL coach, you don't go into your next game without preparing for the other team. They may not do what they've been doing for the last 3 years, whatever their schemes are, but you want to go into the game knowing their tendencies. Be prepared for their tendencies. That's what we do in the stock market with our historical work. We're preparing for tendencies, not guarantees. Invariably, if the market goes down, someone will write into me and say, well, you got it wrong. Growth underperformed. Well, I wasn't guaranteeing. I'm just saying this is history. It's part of, your preparation. It's part of understanding the market, having knowledge that's necessary to trade. Majority of the time, we do see that strength. So I'm just pointing out the reason that it's important is that if this is the top, if we're getting up here at this 470 level, and we start to see 10-year Treasury yield roll over now that we've made our measurement, that would be another significant item that would suggest growth is going to come back into favor. So when it starts to turn in your direction, just as you get to a time period that normally favors growth, you want to at least be prepared for that. So keep that in the back of your mind. S&P 500. Obviously trending down. Listen, I'm still bullish, but I can look at this chart and see that in the short term, we've got some challenges. I don't see anything on this daily chart that screams to me that we just bottomed. Nothing on this chart. I mean, we're below the moving averages. We just got the death cross. PPOs turned negative. Volume's just so-so. AD lines rolling over. On this chart, there's not a whole lot. I mean, I could go back maybe and point to this gap support from February, or maybe this gap support. So, maybe in the 49.40, 49.60 area, 49.80, I don't know, something like that. And yesterday we got down to 49.69. But there's a lot of different levels like this one. I mean, I could go back here to this level, or I could go to this double top breakout. I could go down here to this double top breakout. This was really a big one, getting back through that July high, because that was after the correction and the move from before the correction from 4,600. We went up there and had that double top, put it in almost like a little handle, and then broke out. And we never went back and tested that level. So, I mean, there's so many levels I could look at on this chart and say, yeah, I could see it going to there, or to here, or to 4,800, or even this double bottom at 4,700, double top breakout from 46. And that's the problem with just looking at one indicator. I mean, I don't know where it's going to turn based on looking at this chart, which is why I like to look at some other charts and look at our sustainability ratios, look for divergences on intro, like the 60-minute chart, which I'm going to show you in just a couple of minutes. But anyway, this chart definitely is broken down the near term. And you're going to see that on all of these. Here's the Nasdaq 100. Again, I can go back and look for levels where I think it might turn, but we need to see it. We need to see confirmation, either a big reversing candle on this chart, maybe a period of weakness, a bounce, maybe go back down, put in a positive divergence on the daily chart. Could be any number of things on the daily chart. But again, I think it's, we need to look at some other indicators, and I'll look at the 60-minute charts for you in just a minute. IWM clearly broken down. We do have what I think are two pretty big support levels. We've already taken out the 197.50 area, which was pretty close to the 20-week moving average, which I talked about for a while. From a short-term perspective, that was my last line in the sand. So as far as I'm concerned, this is in a downtrend. But once broken below the 197 area over here, plus that 20-week moving average, then I look to these two support levels, 187.50 down around 190. We could certainly head down to that level. Transports, here was that breakdown below 15.2, little maybe just above 15, pretty close to 15.2. There's your double top. This was a bottoming head and shoulder pattern. We broke out through the 15.2 level, and you can see that's been acting as support. 15.4 was acting as support. We went through both of them with heavy volume, and we've come back up and now testing from underneath. I would not feel comfortable with transports until we get through the 20-day. So even if we do get back up above 15.2 level, and we did close a little bit above it yesterday, and even if we were to go through 15.4, I still think that the falling 20-day moving average needs to be cleared. That would suggest that maybe we're in for more of a sideways consolidation pattern rather than a renewed downtrend. If you go up to the 20 and you fail and come back down, that starts to look more and more like an extended downtrend. But let's go back here now, and I want to pull up the hourly charts. And the reason I wanted to do that is you can see that as we're going down, we had a little bit of a positive divergence on the spider. We've gone through the 20. Maybe we get up to the 50. We got some resistance up here around 5,060. We got the 50-hour SMA, which is currently at 5,053. So that area is going to be, and that's not far from where we are, and it could be hit this morning. I mean, we don't know. Futures are up. So we'll see whether or not we get up there. But moving through that 50 would be good because, as you see, since this started back at the early part of April, we had one little brief moment above the 50-hour SMA, and that's been it. For the most part, we have lived beneath the 20. So if we get up to the 50 and we fail, that's going to reset the PPO, and it might simply be that we roll right back over again. So we're not out of the woods, I don't think, until at least we get through that 50-hour SMA. The Nasdaq, I'll bring up that hourly chart because this one, you can see we haven't been able to get through that 20-day yet. With today's strength in the futures, maybe we open above. But if we open above and have a big red candle in the first 30 minutes, that's not going to have a good look to it here on this chart. But the PPO is rising now. So if we do go back down and have one more low, that could be a pretty important positive divergence that prints on the Nasdaq 100. IWM, I'll look at this one really quick. Hourly. Yesterday we did clear the 50. We closed almost right on it. And I'm talking about, again, the 50-hour, not the 50-day, 50-hour SMA. But I think right now we're kind of in this range. Now that we've gotten back, we've reset that PPO, the hourly PPO at 0. We've got highs in that 196, 196.5 area that I think I would watch very closely to the upside. And then down to the downside, we've established our lows down just around 192 or just below. So right now, that's the trading range on the IWM until I get my next clue, which is going to be breaking out above one, the 196 and change, or below the other, which is actually down maybe around upper 191 range. Let's keep moving. I want to go to the chart of the day. I know we're running out of time here. Again, if you want to start a no-cost trial here at Earnings Beats, go to earningsbeats.com. There it is, Earnings Beats. Maybe make that even bigger for those of you maybe can't see it on the screen. Earningsbeats.com. Once you're there, make sure you start out your no-cost 30-day trial. We'd love to have you. And we'll remind you before your 30 days is up, so you don't have to worry about that. And if you scroll down, you just want to try our free newsletter. Here's where our Earnings Beats Digest sign-up is. Monday, Wednesday, and Friday, we release a newsletter article. Also, it takes the name and an email address. Hit that subscribe button. You're in. And as I said earlier, this gets you in. Just a subscription to our free newsletter gets you into all of our public events. We'll reach out to this entire community when we do that. All right. So I wanted to show you this IWM QQQ chart. Now, this is something I update every week for our members. It's a look at the IWM versus the QQQ. This is what you would see if you pulled up the IWM QQQ and pulled it up on a line chart. This is what you're going to see basically for the last 10 months or however long this goes back. And you'll see that we're starting to strengthen, but we're kind of in this range. We've been mostly going lower, meaning that the IWM has been outperforming. Since November, we've made a move up, made another move down, back, and now we're just kind of sideways consolidating. However, when I take out the gaps and I only look at what is transpiring during the trading day from the opening bell to the closing bell and compare, IWM just broke out versus the QQQ. This is a high that we haven't seen probably since the end of October. And maybe, I mean, it looks like it's about even with that. So we really haven't been higher than that since maybe the second week of October. So during the trading day, it does look like there is money that still is rotating towards small caps. So I'm not giving up on my belief since the beginning of the year that at some point we could see outperformance, maybe significant outperformance by small caps later this year. So this is something I'm watching closely. I wanted to bring it up because again, we show our members this every week, and this is something to watch. Right now, the IWM is down pre-market, QQQ's up, but again, we ignore that. So you're going to see that at the opening bell. You'll see this move down at the opening bell. This doesn't do anything because it ignores gaps. So it's only looking at what happens after the opening bell. So if the IWM gaps down and comes roaring back, this actually, if it comes roaring back faster and goes up faster during the day than the QQQ, this will rise. And anyway, I just wanted to point it out. That's a fairly significant period of time, and we're breaking to a new high. Anyway, for what it's worth. A couple earnings that came out. We can actually bring up the live charts here, and we can see the live reactions. But I'll go through. There's only 5 of these that I looked at. CALX has been in a downtrend. It gapped down. I don't know what the earnings, how the earnings came out, but I don't like the way this is. We talked about gaps yesterday. Remember, talked about continuation gaps, but I was showing you the upside. This is one on the downside. Look at the gap down, rise back, gap down again, going to newer lows. These are just continuation gaps to the downside. Here was another one. So this is bearish looking chart. I know it's got a hollow candle right now. Maybe we go back and we fill the gap, but unless we have massive volume today and this thing comes back up and closes like at 32, if that happens, maybe it's an exhaustive gap. But if we go up and we fail, to get back through yesterday's close and turn back around, I would expect that eventually this goes back, goes down even further. So this was one. CDNS, this was one that was gapping down this morning. So far, trying to come back a little bit. Pre-market, it was down at 266 yesterday after the close. I think I saw 268 this morning. It actually opened much better than that. Looks like it opened right on this price support coming across. This one I would have I'd like a lot better than the last one. I think CDNS looks better than CALX. But let's see how they finish. That was one of the things I said yesterday in the webinar. When you get these gap downs, the first move was to the upside. Looks like, oh, we're going to have this big hollow candle. Now we pulled off of that earlier high. We don't know where this is going to finish. We don't know what kind of volume we're going to have. You can't really get that full confirmation until you see the close today. And even possibly trading the next couple of days. But I at least want to see how they finish. Everything before that is probably jumping in just a little bit premature. Crane CR. This is a company reported they're actually up just a tad. They were up much more than that earlier. They were up around 136, 137. They never really opened there. Is this? Oh, this isn't today's action yet. So let me pull up CR pre-market and see if it's still showing. Yeah, it's actually showing $9 at 9:14 this morning, up $9 today. So that would be all the way back up here at the high, maybe even opening above key resistance. That would be a bullish open. Let's see. MEDP, Medpace. All right, this is today's open right here. This one was higher. It was actually lower overnight. And then this morning it was up, and now it gapped up, and now it's lower. And again, Where is this thing going to finish today? I have no idea. It could be a huge red candle to come down and maybe test the breakout that we had in February. Maybe it reverses off of this, setting a new low, creating a lot more sellers. Maybe it reverses up and goes all the way back up over 400. I have no clue which way this is going to go. So on days when these earnings come in, if I see a really good report and it gaps down and trades down early in the morning, sometimes I might take a shot for a reversal, but that would be an aggressive trade. It still would be, I think for most traders, would be better off waiting to see how the stock trades and how it closes that day. Last one I have for you is PKG, Packaging Corp of America. And that was a big gap down today. Almost a little bit of a head and shoulder, left shoulder, neckline, head, left neckline, which is down sloping. And then the next day we went up, set a right shoulder, and then we break down and we'll see what kind of volume. Right now, not a whole lot of volume, but maybe moving back up. That 177 level is probably going to be difficult for the stock if it does move back to the upside. And this is one that's been in a nice uptrend. Even with this low here, you can see we're still in this pattern of higher highs and higher lows. So again, this is one I want to see how it finishes today. All right, quick update on what's going on in the market, and then we will wrap this thing up. Dow up 0.2%, S&P up 0.4%, Nasdaq up 0.5%. Small caps have actually turned positive, so that's good. And the VIX now down 1650. It closed yesterday below 17. I think 17 to 20 is kind of like, when the market's kind of percolating, doesn't quite know whether that's going to be the end of the move to the downside in the market and the end of the move to the VIX to the upside, or if it's just starting. And right now we're getting at least the start of an indication that the VIX is it's rolling back over from elevated levels. We do have a couple big reports later in the week, though. Keep that in mind, GDP, and then that personal income, personal spending report, Thursday and Friday, respectively. Those are going to be two big reports. But at least for now, it looks like some of the fears coming out, and that's good news for the bulls. So unless you see a big reversal on the VIX, I would expect that the short-term gains that we're seeing, we may see that continue today. So anyway, that's it for me. Appreciate everybody tuning in. Have a great day. Happy trading.